Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Hart, welcome back. How are you?
I'm awesome. How are you?
Good, good. Before we started recording, we're talking about how it's changed quite a bit being a landlord in Ontario in 2023, 2024. And that's what we're going to talk about today. But before we do, what is new and exciting since the last time you were on the show?
Well, super new and exciting, not too much. The nature of the market has changed a little bit, but our day-to-day doesn't a ton. We're leasing out properties across Ontario. We're doing a lot more property management these days because I think a lot of people are kind of fed up being, landlords. They want to be investors. So we're doing a lot more of that. And, we're introducing some new cool, innovative tools to help on the management side. And then, yeah, just enjoying the winter time, trying to get out there, get outside, have some work-life balance, have that with our team. Mental health is important. And I think we've all been grinding for a couple of years now. So just making sure that everyone feels a little bit more balanced than maybe the last 12 months.
For sure. Now you have a new baby, I believe, as well, since you were last on.
Yeah, I don't remember exactly when it was, but he would have either been absolutely newborn or non-existent, but he's 9 months old. Yeah, you may hear him wake up from a nap in the background, but he's awesome. It's really enjoyable being a dad. He's an easy kid, thankfully, just happy. And yeah, it puts into perspective kind of that balance thing that I was talking about. 5 o'clock every day, I walk in the room and he's just happy to see me. So it's a fun time.
Awesome, awesome. Love that. All right, so let's talk about obviously, and I don't know how long you've been in this business for, but I've been in this business for 10 years. When I first started, it was such a different game back then. And we'll talk about landlording specifically, not necessarily strategies per se, but from, when we first started buying properties, the rents easily actually covered entire house mortgages and
Yeah.
interest and taxes and everything. And you still came out cash flowing back then. And then over the years, obviously, we had to pivot and do some, conversions with multifamily and that kind of stuff to make it make sense.
Mhm.
But the rents have changed quite a bit. I think and this is where your expertise will definitely come in handy to share what you've learned. But tenants aren't the same anymore. They're not the same anymore. The LTV is still a crapshoot, and it's not getting any better. But what are your thoughts? Like, what is happening? Let's just say since the pandemic and since things started reopening again. What are you seeing? Because there's definitely some big changes.
Yeah, for sure. It's a big question to unpack, I would say. But we actually ran a rent report looking back at all of 2023 and then got a little bit of insight into the fact that 2023 was a very difficult year for landlords. And we pulled 5 years of data instead of just 1 year of data and found that last year was actually the worst recorded rental year. And I'll talk about some factors of that in the last 5 years. And that's not to say that investing in landlording isn't possible anymore. But by the standard metrics, it has changed dramatically. So rent is going up. We all know that. The CBC and every news source has been, on the topic of rent increases and how crazy they are. But the reality is when you look at the rent increases across 2023 in Ontario, their rent is high, but the rent increase has actually slowed quite dramatically to just around 3.3%. And inflation, if you trust any of the numbers out there, is like 3.4% recorded right now. It's probably a lot higher. So to your point, being a landlord has been more difficult, primarily because, rent increases, as much as we can do them, even with tenant turnover, haven't really kept pace with inflation. So not only has the cost of building places and renovating places and, hiring out tenant placement services or property managers all gone up, your cost of living has gone up as a human being, and the tenant's cost of living has gone up dramatically, but things are still not keeping pace. And so everyone is having an affordability crisis, essentially, and placing tenants has become more difficult. And the choice of tenants has become a lot more slim, I would say. So we've got some facts that we can dive into in a little bit. but quantitatively, the quality of a tenant has actually dropped across the board in 2023, especially. Rent increases have slowed. In Q4 of last year, rent actually went down in most Ontario markets across the board. And there's issues of market saturation and whatnot, but we can dive into kind of each one. But I would say over the last year, it's been the hardest year in the last 5. And when landlords start to look at themselves as investors and evaluating new properties, the lens of how to evaluate a property needs to change. And like you said, strategies have changed. But even with existing strategies, if you know and love the BRRRR, your numbers need to change from a BRRRR perspective in terms of longer vacancy costs to allocate. Like last year, vacancy periods increased by 16%, which is substantial. Even in a tight market like Toronto, the average time to lease was about 14 days. That went up to 18 days. May not be super substantial when you're evaluating a property, but that's just medians and averages and whatnot. So you need to keep in mind where you're investing, what your numbers look like, and just have a little bit more of a conservative nature coming out of 2023. That's for sure.
Yeah. Now you've mentioned Ontario, there's lots of submarkets. Do you think that this is also relevant and applicable in the rest of Canada from what you're seeing in terms of stats and longer fill times, rents not really increasing as much? Are you seeing that across the country?
Yeah, for sure. And when we look at the numbers across the board, really we look at tier 1 markets. So Toronto, Montreal, Vancouver, that's essentially it. And then we look at tier 2 markets. So we've got, Hamilton, even like Edmonton and Calgary, out east when you're out in, St. John and all the eastern provinces. The same trends are happening across the tiers of cities. And the issue is even more acute in tier 3 cities. So when we talk about tier 3 cities, those are, around 80 to 120,000 people, typically and historically, blue collar working towns that have had less investment over the last, 10 years. But in the last couple of years, they've gotten a lot of investment. And I know well, and we know well from an Ontario perspective. But when you look at even a city like Regina, or you go out and you get to BC, which is a little bit of a different beast, but you get into some of the smaller markets in BC, the same issues are creeping up where a lot of investors have put a lot of money into those markets to try and develop the rental ecosystem there. And tenants just can't afford the increased rents. The tenant pool is drying up because those who could afford those brand new, nicely renovated places have found their places and they're not moving because rents just keep, going up and up and up and up. So the same trend is happening across the board. And as an investor, we always look at it as, am I in a tier 1 city, a tier 2 city, and a tier 3 city? And, we just need to look at how we evaluate those properties a little bit differently.
Yeah, no, that's really good insight. Now, obviously, even just from our experience with renting in the current market in Welland and Hamilton, in those areas, because we have a lot of units coming to market and more continuing, it definitely feels like a different market. It feels like it is harder to get the right tenants, harder to get the price as well versus even 2 years ago. And I think people have less disposable income that they used to. And like you said, I don't think they're moving because if they're moving, to get something of, I would say the same amount is going to cost, or like the same amount of square footage or the same space is going to cost them significantly more. So that's what we're seeing, I think, is a lot of people not moving or staying put. And then the people that are coming, I don't know about you, but I'm seeing a lot of like international students still coming and applying, people from out of town, obviously like splits and divorces, that kind of stuff. But, if somebody got a place a couple years ago, likely they're staying put unless, there's a specific reason to move.
Yep.
So what about like vacancy specifics, right? Like across Ontario, it was sub 2% for the longest time. Has that changed at all?
Yes and no. So I will say I will agree with all of the skeptics out there at major banks and government establishments that essentially CMHC can't count. And apologies to anyone at CMHC who is listening in. But CMHC has an issue with the way that they report on the rental housing industry. It's part of the reason why 8 years ago we thought that building a tech platform was such a great idea, because the acquisition of data for this secondary rental market is so important. The secondary rental market and the landlords who house everyone account for 68 to 70% of all rental housing in the country. And when we say the secondary rental market, CMHC defines that as anything not purpose-built rentals of 3 units or more. And actually dove into the CMHC report this year. They define it as 3 units or more, but they actually don't report on data unless there's 4. They had an interesting term for it, but like essentially 4 units. So if they had 4 established and distinguishable pieces of data coming back on 1 unit or 1 property, then they would count it. So the underreporting of single family homes, bungalows that were converted into duplexes, triplexes, is incredibly rampant. And so when you look at the vacancy rates, to answer your question, yes, CMHC said the vacancy rates are dropping and we're under 1.5%, especially in these tier 1 markets. When we look at the data that we've pulled, especially in these tier 2 markets and tier 3 markets, we're up at 4, 5, 6% vacancy rates. And I think when you talk to property managers and investors in those markets, you hear them sitting on vacancy for 30 days, 60 days, even 90 days is not completely abnormal, especially for those who are willing to wait for the right tenant. Anyone can place any tenant, but if you're willing to wait for that perfect tenant, then you are going to have to wait a long period of time. So vacancy rates aren't as CMHC reported them. Yes, in Toronto, they may be reported as 1.5%, but if you take with that grain of salt that they're not reporting on any single family home, basement unit, duplex, or triplex in Toronto, obviously that accounts for a massive amount of housing that they just have no idea what's going on. So I would say as an investor, caution towards being more conservative. And then when it comes to quality of tenant, we actually did a little analysis with Single Key that we're partnered with and looked at the quality of tenant across 2023. And the quality of tenant has definitively dropped. So the data, if I take a look at it, is the average credit rating went from 687 to 675. So not a massive difference, but when you look at that in terms of a median number, it's not, not substantial. The crazy numbers, bankruptcies went from 2.4% to 4.5%. So clearly people are having trouble affording what lifestyle they've gotten into. And then the same thing from a collections perspective, they went from 10% to 18% collections. And that's across all of the applications that us and Single Key see.
Oh, okay. So just
yeah.
because I want to just verify. So the stats come from the applications that are coming in, not the population as a whole or like
exactly.
Okay. Got it.
Yeah, so this is an evaluation of active rentals and renters essentially. So we're looking at all of the applications that come in, and there was an analysis of about 4,000 to 5,000 applications, and looking at the median credit scores, collections and bankruptcies across the board, and also the rent to income ratios. Those have been shifting quite dramatically over the last 5 years or so. It used to be the age-old 30% rent to income, and then it creeped up to 35, and then we see 40, and then if you're in Toronto, it's not unusual to see 50% rent to income. And people are just spending more on a roof over their head. So it's the reality of the market that we're in right now.
Yeah. And to be honest, like if anything, I think it's going to get worse for a bit in terms of landlords. Well, I think it's going to get worse in general, probably for a bit, but I think even just landlords like leaving the market as a whole right now. In the grand scheme of things and in the long, in the long run, we're going to have less housing, in my opinion, as people are just starting to sell. Because, and you probably speak to a lot of investors right now, they're trying to figure out, okay, do I rent these units? And then if they're rented and then they're with the higher rates, like, does it even make sense to keep it? Or, do they sell it and just get back into, something different, different type of investment. But, so, I mean, obviously the income is not where it used to be for a lot of renters. The amount of rents, is still high, in comparison. What are maybe some strategies that you've implemented or that you're seeing others implement to try to fill those vacancies?
Yeah, it's a really good question. And I would say the creative strategies are still in their infancy because, Q1, Q2 of last year wasn't too bad. But as we got into Q3 and Q4, things got really sour. Q4 was absolutely terrible. And, I'd share my screen and bring up all these graphs. But essentially, when we looked at every single market, the number of new listings on the market continued to spike. Investors were turning over these renovated units, dropping new units on the market, and the number of total leased properties was plummeting, like down to 2020 levels. So there was an extreme problem with finding quality tenants and actually placing them. But then at the same time, the median rents weren't moving. And so people just were saying, hey, I'm not willing to rent below X dollars, and I'm just going to wait on it. And then as you pointed out, they wait a month, 2 months, 3 months, and they go, well, I'm not going to drop my price because it doesn't make sense from a numbers perspective. I'm not going to put a bad tenant in that property. I'm not open to placing, 4 people in a 2-bedroom unit, which is, what people can afford these days and what, cultural norms are with new immigrants. And so I'm just going to sell the property. And we had a lot of landlords doing that. But the reality was, when you're trying to fill that vacancy, as a leasing specialist and a team of leasing specialists, we're pushing as hard as we can to figure out different ways to fill those units. And typically it's, price drops, because price is going to be the biggest determining factor. And so the first batch of strategies is pricing related, but knowing that people are going for refis and people are going, in larger buildings for their CMHC. So keeping that rent roll high, but being able to drop the price. So we see a lot of, first month's rent discounts, 2-month rent discounts, 3-month rent discounts. You obviously don't want to go past that because then it's the actual rent. We've seen incentives like, Visa gift cards, or like free, PS5s and things like that, if you're going after certain demographics. I would say those are kind of like the price related things. We've even gone to the scope of, placing an advertisement out for $1. And this is like my most hated thing back in the day, but post a property for $1 and say, offer, what price you can afford. And you see the offers coming in similar to the buy and sell market, around what the market average should be, because people know, I'm not going to waste my time just offering whatever. I'm going to offer what I think market rent is. So we've been able to place a couple properties like that with those incentives. In markets like Toronto, we've been very aggressive with incentives. If you're renting out a $4,500 a month 3-bedroom townhouse, you can put a $1,500 first month's rent discount in there. You can say, 3/4 of your rent is discounted in the first 2 months, just to get someone quality through the door. But then when you look at some of the smaller markets, those incentives can't be as extreme. And so they're not as motivational for those tenants. So giving someone, $100 off in rent, it allows you to then advertise the place $100 less and get more initial traction. But it's not going to move a property that wasn't moving elsewhere. So a lot of the conversations are with the investor to educate them on how the state of the market has changed. And, the demographic that they're looking for may not be out there anymore. And so shifting that strategy a little bit. The other thing is, for any investor or landlord out there that isn't posting across multiple platforms, like gone are the days of, I used to, post on Kijiji and I'm just going to post on Kijiji. When we're doing leasing, we post out across Rent Panda, Facebook Marketplace, local Facebook groups, Kijiji, rentals.ca, Zumper, Padmapper, View It. Like, you have to be everywhere, because that one quality tenant may be anywhere. And they may be on, searching on Airbnb and then be convinced into a long-term rental because it makes sense. And so you have to look at a multi-platform advertising strategy. And then the last thing is really just hustle. So we always say to landlords, if you're not willing to put the work in yourself, you have to hire someone that is. And nothing bad about realtors, but typically realtors are focused on buying and selling their homes, and they may do you a favor and, rent yours out if you bought the property with them. And so if you're advertising a property, you have to be on when the tenants are on, right? Tenants are scrolling on their phone at 9:30 at night, just hitting that "is it still available" button on Facebook, right? And so if you're online at 9:30 at night, getting back to people at the same time that they're engaging, then they're going to convert a lot better. You're going to catch them. You're not going to have the drop-off rate that you would experience if you wait 48 hours and then respond to everyone. So we always kind of try and educate landlords to think like you're selling a product and understand your customer, because that's what you have. You've got a product in a house, whether it's a rental or not, and your customer is that end user, that tenant. So it's the same as selling, a car or a running shoe. It's just a house.
Yeah, I mean, there's a lot of stuff I want to unpack that you talked. I mean, you mentioned a lot of things. So just a few things though, and one comment before I go through some questions for you. But I would have never thought 2 years ago we would be in this situation where it's almost reverse, right? Now we're doing incentives. Now we're doing discounts. We're like, I've always done month to month, except for recently where like 12-month leases actually make sense now because you don't want them to just, randomly walk away without penalties and stuff like that,
Yeah.
for newly renovated units that we're doing.
Mhm.
And so that's definitely been a shift again, and it probably won't last forever, but that is the shift now. We're very similar to probably some places in the US where they were offering incentives to try to get renters in. Okay, so there's one thing that you mentioned, and I don't know this, so like thank you for educating me on this. But you mentioned that if it's 3 months on a discount, it becomes lawful rent. I thought it was just like you have to do something different, so it doesn't become lawful rent right from the start. But you would know more than I would on that. How does that work?
Correct. Yeah. There's a little bit of a gray area, I would
Okay.
say, in cases at the LTB that have kind of pushed through some odd case law. But yeah, essentially, if you can't go into a lease and say, hey, the lawful rent is $3,000 a month, and I'm going to give you an 11-month rent discount of $2,000 a month for that entire time. Because if on the 12th month you turn around and say, great, now you owe me $3,000, the tenant actually has case to not pay you $3,000, continue with what is considered lawful rent. And then if you file an N4, they would let you go through that filing and you would lose at the LTB. So the 3-month line is kind of that general standard of what is considered lawful rent. And you can do things within that realm. I would say like there's a common sense practice of, you can't be extreme and then essentially open up yourself to liability from a tenant perspective to say, hey, this is gouging or there's something fishy going on here. So you wouldn't want to go in and say rent is $6,000 a month or
Right,
$10,000 a
right.
month, but it's $1 for the first 3 months, right?
Yeah,
Because
wouldn't it
then,
make
yeah,
more sense though to collect all the money up front and then just do an e-transfer back or like gift cards back instead?
collect all of the rent money up front.
Yeah, so let's just say it was $3,000, but you're giving them $1,000 off for like the first 3 months. Wouldn't it make more sense to collect on the first of the month the 3,000, and then on the seventh of the month or whatever it is that you decide to just send back 1,000?
Yeah, so I would kind of say that you probably get into the game of who's trusting who,
Okay.
and tenants may just be like, I don't trust you to give me back that money. And then to your point about affordability beforehand, we're seeing more and more tenants who just can't afford those types of payments. And so a lot of people are living, paycheck to paycheck these days. And you see less of like hey, I'll give you 3 months up front or 6 months up front. It's typically only new immigrants who have money coming over from another country. And we're seeing like when we do bank checks, so we can do open bank checks now to see 12 months of payment history through a tenant's accounts. We see much lower bank balances than we used to. People aren't sitting with, $15,000, $20,000 in their account anymore. They're like redlining every month and going paycheck to paycheck. So that would kind of be my one pushback with that model is like we don't see tenants with lots of cash ready. And more these days, even the idea of giving first and last upon lease signing, more people are pushing out to say, hey, I'll give you the last month's rent deposit, which is legally the only thing that you can accept, but it's just kind of industry practice to take both. And saying, hey, can I give you first month's rent the day before move in, or even my next pay period if you're
Right.
signing at least 60 days out. So everything is tighter these days.
Mm.
And to your point, I don't think it's going to change anytime soon. I think we're going to go through a tough Q1 and Q2, maybe, and hopefully as we get into the summertime, things will ease a little bit. But as landlords, we kind of have to put ourselves in the tenant's shoes and say things are tough for them too, right? Affordability is tough, and paying high rents for the same thing that you could get for 40% less, 2 or 3 years ago, is actually affecting those who work, middle income jobs, hardworking blue collared families. But yeah, it's changed.
So how would you suggest that somebody do it then? Like if it's not the 3,000 and then 1,000 back, like what is your practice?
So typically we want to make sure that we're not misleading. And we would allocate about a 10% rent discount when per month for 1, 2, and sometimes, but rarely 3 months.
So is
We
that on
like
a
to
separate
say,
contract? Is that on the standard lease? Like, is that like how, like, walk us through the actual
oh
logistics?
yeah, yeah. So it would be on the standard lease. Everything is above board. So if you're renting out a place for $1,800, you could give them a 2-month rent discount for $180 a month. And the real benefit of that is that if you're advertising at $1,800 a month and everyone else is around that range, you would put up your advertisement at 1620, and you would very clearly note at the very top of the advertisement that yes, the advertised price is 1620, but that is including first and second month's rent discounts. After the first 2 months, your full lawful rent is $1,800 a month. And in your pre-screening, you would have people accept the fact and like click an actual box to say, I read and understand that the lawful rent is $1,800 a month. Because you also don't want to waste your time with people thinking that 1620 is the rent. And so that's typically the way that we do it. We put it on the lease, we advertise it very clearly, and we're not false advertising. We are playing with essentially the marketplace, algorithms and dynamics. Because as a tenant, if my budget is 1,800, I'm using that little slider bar and I'm probably looking at 1,850 and 1,750, maybe 1,700. And so you're just going to get more volume at the lower price. And especially with Facebook, higher volume equates to higher engagement. And I think we talked about this last time, actually. So people can go back to like how to get high engagement on posts. But engagement breeds engagement, especially on Facebook. So you want to respond quick, get lots of people, and then you'll get more people.
So is it just, sorry, I just want to wrap my brain around this.
Yeah.
It's on the Ontario Standard Lease, like the main forms. I don't think there is space to write this, right? So you would just do it as an addendum?
No, there is space to write a rent discount.
Okay.
Yeah, in the Ontario Standard Lease. I would probably spell it out very clearly in an addendum also.
Got it. Yeah, because I think you can just check it, right? Like it's like a checkbox or something if there's a rent discount.
Yeah, so there's a checkbox and then there's
a couple
what is the
lines.
rent discount?
Okay.
But the general rule with the Ontario Standard Lease is like there's lots of margin room. And so sometimes building a lease appendix, which you should have anyways, can be a pain. So sometimes we just put little addendums kind of as elements like text boxes beside that if you need to explain it. And we've seen it at the LTB where essentially a little text box on the Ontario Standard Lease with an additional clause or clarification of an existing clause is essentially considered the same as a true appendix.
Okay. Or work with a company like Rent Panda to get all your stuff done properly.
Yeah, exactly.
So you mentioned advertising and you mentioned Kijiji, Facebook's View It, et cetera. Where, let's say, does your majority of leads come from that end up turning into tenants?
Yeah. It's all market dependent, I would say. So the tip here is wherever your property is, really understand the top marketplaces in that market. For us, Facebook Marketplace still brings in the large majority of volume and the largest percentage of closed deals. So Marketplace and gone are the days of bad people are on Marketplace. It's just more people, so it's more to sift through. And then recently, actually, Rentals.ca and Kijiji have been closing the gap. So for quite a few years, we found them to be kind of useless, especially Kijiji. It kind of died off. It was the old bygone. But they've done a good job at pushing their marketplace, doing a lot of advertising, building better promotional packages. So they've started to creep up. And then we also have the ability to post out to the MLS now. And so if you're looking at a city like Toronto, you want to make sure that you're on the MLS. If you're advertising in Kingston, there's like 7 properties a month that lease out on the MLS. So there's no point in being there. So it's really market dependent.
Yeah, it's interesting. Yeah, I know we've had some good luck with the MLS as well. And the fact that you guys are now able to do it, I think is huge too, because now you're able to do the whole gamut of opportunities, not, just everything except for the MLS. Because there are going to be some people that, and oftentimes these are business professionals that may not have the time to like decipher through everything. And they're just like asking their friend who's a realtor or whichever realtor they want to use. And then they're getting help that way. And so, sometimes there's some great tenants that end up coming from the MLS, which I would say before 2 years ago, I never really even bothered. It was literally just Kijiji and Facebook and predominantly in the markets that I was at, Kijiji back then. But things have changed. And I think, like you said, I think Facebook now has become, again, for most markets, not everything, but has become the predominant way of finding tenants and getting that traction. So obviously you're seeing, a lot more, I think, difficulty in renters coming out and markets have definitely changed. are you seeing anything positive? I mean, we talked about a lot of the doom and gloom, but what positive things are you seeing potentially happening for 2024?
Yeah. Lots of opportunity for those that understand the smaller markets that they're operating in or where there is market opportunity. So we're seeing, like you mentioned beforehand, a lot of opportunity in student rentals. There's a lot of students still coming, and yes, the government passed some new legislation and is pushing, the universities in particular and colleges to offer housing to students.
Yeah, can we talk
But
about how is that going to work? How are they going to find the housing? Are they going to build it themselves, or are they going to have to like just identify investors like us?
So what we're pushing for, and as an investor myself in student rentals, what we're pushing for is a collaboration between the private sector and the public sector,
Mm-hmm.
because they're not going to be able to build all the housing themselves. What it'll do in the short term is it'll limit the number of students coming through the door, especially in first year. We were seeing cohorts of university and college students that were made up of a third of international students, and there was already a housing crisis beforehand, and the volume of people coming in were incredibly large. And then you had a lot of landlords who were taking advantage of that, putting 6 to 8 people in a 2-bedroom house because they could get a lot more money for it. So it's always the bad apples that ruin it for everyone else.
Mm-hmm.
But I think the long-term solution has to be one where the universities kind of push for government reform from a legislative perspective on the zoning front, because building student housing is very difficult in a lot of cities. And then I think if you look at the zoning for small boarding houses and the opportunities for investors to jump into that, which is what I'm personally looking at, that's a big opportunity, but it needs to be started at the government level. The zoning laws need to change to allow for a broader range of neighborhoods to allow for this type of housing. And then, in the short term, people are really scared. They think, the number of new students coming to the market is going to be halved, but they forget about the 4 years of, students that have been enrolled that
Mm-hmm.
are still going to require housing, and master students and PhD students. So I think by the time kind of the current cohort runs out of need for student housing, not only are they going to dump into the standard rental housing sector, so that's going to cause that problem there, but there's going to be some changes that allow for these students to be housed, and I would expect the number of applications to rise back up. Maybe not to like COVID levels where universities were just trying to make a lot of their money back, but it'll rise back up. So student housing is a massive opportunity. Obviously, the addition of extra units is still kind of the thing that everyone is talking about, whether it's garden suites or basement units or any kind of ADU. So we're seeing a lot of our clientele pushing, those extra added units and adding value in that way. And those units are going for a premium for sure. Garden suites are the hottest thing on the tenant side as well.
Mm-hmm.
And so we're seeing a lot of movement actually back to major markets like Toronto, where, a garden suite tacked on to a renovated, duplex into a triplex, and you've got your 4-unit property. We're seeing Toronto properties actually cash flowing, which is
Mm-hmm.
kind of crazy to see after the last, 5 years essentially in the city. So people that were investing in, Peterborough and Welland and Trenton and whatnot are actually coming back to the city. So there's opportunity to increase density there, to have profitable investments that are coupled with, cash flowing opportunities, coupled with high levels of appreciation like Toronto is likely to see in the continued future. And then the last thing is just that there still are really good tenants out there. And the trend that we were seeing in Q4 and at the start of Q1 is starting to change a little bit. So we always look at, the past year to try and predict the future year. And if we look at it on a month by month basis, even the last 2 weeks has been much better than the 2 weeks prior, which were much better than the 2 weeks prior. So we're hoping that with our graphs, seeing that massive decline in the doom and gloom, we're seeing that slight little uptick. And the hope is that as we enter into the spring market, that uptick starts to, properly rebound.
Mm-hmm. Yeah, that's great points there. So student rentals,
Yep.
ADUs, and looking potentially back into Toronto as potential good solid markets for the long term that may now potentially cash flow a little bit.
Yep.
So do you know if because they had a quota of like
Hmm.
900,000 students or whatever, like is it after that, or are they just kiboshing that number? for
No,
like,
so that's where that kind of legislation or push still exists.
mm,
But my prediction is it's not going to affect the volume of student housing quite as dramatically as every news source was saying in the first 5 days. And that
mhm,
story worked out rather quickly because there is still that 4-year cohort of students that is rolling through from a student housing perspective. And I would imagine, the university and college lobbyists are going to do a good job over the next 2 years of pushing the government and
mm,
saying, they may not have the housing right now, but they've put in place a plan for the housing. So they should start to relieve, the number of applicants that can be put through. So
okay,
the number is there, but I don't think it's going to
mhm,
be as dramatic or create the actual ripple effect that everyone thought on day one.
mhm.
And I think just the pace of that story burnt out is kind of going to show you that those who are invested in student rentals, haven't thrown up their arms. There's no protests happening. The universities and colleges haven't done, major pushes to protest this because I don't think there's going to be a massive impact.
Interesting. Speaking of
Yes.
Toronto, and then we'll wrap up. And I don't know if you've, and again, like this is, I just read something about it the other day. You
Yep.
may know more about it, but something about like opening up the opportunity for more rooming houses, or being able to rent by room. Have you heard of anything like that?
I
Thoughts?
probably read the same article. I haven't seen any legislative changes or proposals. But yeah, I've just read that article. On the student housing front, I hope that it's a trend that continues across most major markets, because I think alleviating or pulling back the boarding house laws and bylaws that exist will help density in existing structures. Because typically, as investors, we've always looked at these houses and you have to chop them up to make the numbers work, right? It's
Mhm.
the bungalows into duplexes, it's the single family homes into triplexes with the garden suite on the back. But we were personally looking at a century home that could have had 9 bedrooms, 10 bedrooms, 12 bedrooms, and chopping it up was just cost prohibitive.
Mhm.
You don't want to touch anything structural with that type of house, and it was cost prohibitive essentially. So I think
Right.
the loosening of those laws will allow these houses that are just going to be torn down and turned into, the
Mhm.
typical suburban mega mansions. It'll allow investors to come in and put in place quality boarding houses and
Mhm.
house the population that needs it, whether it's students or new immigrants or just young professionals,
Mhm.
without having to invest as much as they have in the past with true conversions um, or just push towards, the tear down and rebuilds.
Yeah. And now we just have to make sure that insurance and finance, all the banks and the lenders are
Yeah.
also on board, because that's going to be the other side of things, right? It's like one thing for them to like open it up, but then you've got to find the lender that's going to finance it. And then
Yeah,
you've got to
for
make
sure.
sure that it matches with, the insurance and the insurance requirements, that kind of stuff. So,
Yeah.
but it's at some point something's got to give, and I think that there's a need for that. Like you said, there's a lot of people that are finishing school and they may not want to go back to live with their parents, but they may not want to be in a student rental anymore and probably can't anyways. So that's like a nice easy transition. They're probably young
Yep.
professionals. Could be very interesting.
Yeah. And I
Hard,
think
yeah.
oh, sorry, my last bit on that is I think, the money will always dictate it. And so if there is a push towards permitting boarding houses and or having a licensing program where there's opportunity for the government to make money off of it, it will likely be pushed through a lot faster. And I think from a cash
Interesting.
flow perspective, there's an opportunity there. Like I would get licensed as a boarding house provider.
100%. I would
Yeah.
too. And because like if you have like 9 or 12 rooms, even think about seniors.
Yep.
Seniors. Perfect example. But again, like we go where the money is, right? And the
Yep.
government goes where the agrees with
Exactly.
whatever happens if it makes them money, I suppose.
Yep. Exactly.
Awesome. Hart, just quickly, what do you offer with Rent Panda if somebody is interested in
Yep.
your offerings?
For sure. So Rent Panda is essentially a rental company that supports small landlords through their entire journey. So for those who are still in the DIY phase, doing everything themselves, we offer software to help place and manage tenants, most of it for free. Then for those that are looking to be a little bit more passive or have trouble placing tenants, we offer leasing or tenant placement services across all of Ontario. And then for those true passive landlords, we offer flat rate property management, again, across Ontario, as low as $39 or $49 a month for larger multifamily, up to $99 a month for single family homes, and everything in between. And then we also just provide, education, coaching, paralegal services, and stewardship of your rental journey. So it's not very transactional. It's all relationship based, and we like to see people through their entire life cycle.
Okay, awesome. And where and what's the best way to connect with you and your team?
Yeah, just rentpanda.ca, as easy as it can be.
Awesome. All right, thanks for being on the show. It was a pleasure having you on.
My pleasure. Excited to be back again.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?